Now, this is the Insight Empire, of course, the home of trading insights. Now, my name is Blue Bull, and I want us to have a conversation because I've been trading. This is my 6th year, and I've been able to achieve immediate success in various parts of life, specifically through forex trading. And now, the one thing that I want us to have a conversation about in this particular video, actually today I'm not going to share trading strategy, but if you want to learn trading strategies, I've done so many videos explaining different entry approaches that you can be able to leverage on and profit in the financial markets. Now, the name of this conversation is called Why Order Blocks Fail. Why order blocks fail? Because order blocks are one of the 7 institutional reference points which are taught in the ICT, and basically these order blocks are perfect entry model for so many people. But now we want to explore why are people still hitting stop loss despite that order blocks seem so easy to trade. And before we continue, I'll take my time to explain briefly what an order block is, and then we see why actually do they fail. And I've lighted down 5 reasons why the order blocks fail, and I want you to follow with me each and every reason so that you find yourself not basically failing when you're trading the same approaches. So let's start. Basically, what we call an order block is the last candle before an impulsive move that should lead to 2 things: either a break of structure or a market structure shift. And basically how we trade an order block is after every impulsive move, we expect the smart money to revisit that particular zone where the impulsive move originated from. And during the second time of the revisit is when you want to engage with the market and trade effectively. Now, let me break this down. For example, if we have a market going in this manner, and then of course it happens to have an order block here. We have an order block, which is basically the last candle. Most of the times it's the opposing candle, which let's say it's a bearish candle. So 2 things should happen from the time when this particular candle prints. From the time when this particular candlestick, which is around this particular zone, prints, 2 things are supposed to happen to qualify this candle to be a high probability order block. The first one is we must have a rally taking out the previous swing point. This rally is critical because it shows that there is indeed smart money involvement in the market from where that particular candle printed. Remember, this is smart money involvement is our main interest because we do not want to compete with the big boys. We want to follow their footprints because they leave footprints anytime they are trading. So we want to do exactly as what they are trying to do because they're the people who have the capacity to push the market significantly. So if this is the last candle that it printed, and then we had, of course, a rally upwards, taking out the previous point is very critical. It shows we had people with muscles, with strength in the market that enabled them to break a structure to the upside. So in case now I was trading this out of market as a B or S, which basically means a break of structure to the upside, and we can have a break of structure or a market structure shift, which are both of them are still very much important. So when we have a break of structure to the upside, it is a signal that from where the candlestick printed, we had a very impulsive move to the upside, indicating smart money already in the market because they were the people who had enough capacity to push the volume to take out the previous swing high, and then we want to expect the market to retrace back. Okay, the market retraces back to the initial origin of the rally, and then that's where we take our entry for a long position. Most of the times with our stop loss just below that particular low, and the target is always the previous high. And this time most of the people are able to get a 1:2 or a 1:3 risk to reward ratio. As you can see, this one is giving 1:5 risk to reward ratio if you were supposed to trade, for example, in this particular, assuming now this is a trade that you are in. This is because this is basically the traditional model of trading a traditional order block. So we want to see why do this setup model most cases fail, because so many people end up still blowing their accounts or hitting a stop loss immediately they trade based on order blocks. So we are trying to break down why do order blocks, which by design are supposed to be high probability trades, but I've discovered that most of the people I've engaged with, they told me they have a problem with the trading order blocks which seem to be raw probability at first, but still they find out that they have blown the account trading the same order blocks. Now I'm here to give you 5 reasons why the market the order blocks might fail. And we start right now. Now, the first one is inefficient or a weak order block. Inefficient or a weak order block. Now, an inefficient or a weak order block is an order block that does not result to a break of structure or a market structure shift. So any order block, because they are there, that you discover that it does not have a break of structure or it does not have a market structure shift, that order block is by design a low probability order block, and it's not a reliable entry to enter based on. So that's not a very good confluence. So long as any order block, the last candle, not every last candle before an impulsive rally should be considered as an order block, because if the order block does not have a break of structure, it means that the people who engineered liquidity from where the last candle printed, which by design is that order block, they did not have enough volume to push for the market, and quite often they might not revisit any orders that were left during the formation of that particular candlestick. So anywhere we have a weak order block, that is a place you should not trade based on that particular order block. Now, the second reason why the order blocks basically fail is because of liquidity sitting above or below the order blocks. Now, most of the order blocks are basically the last candle to print before an impulsive move. And this is what makes it a low probability setup, because from where we have a last candle before an impulsive move, literally by design, we are likely to have an external range liquidity. Now, what is external range liquidity? External range liquidity is the liquidity that lies below or above all the highs or all the lows, or previous high and previous low. So, for example, in this case here, this candlestick that printed here, for example, the candlestick that printed here, this was the last candle before a reversal to the upwards. So if you have to mark out this particular candle, like this, for example, you will notice that there is external range liquidity, which is basically the liquidity lying below, because those people who bought from this particular candle, they had stop losses down over here. So this is external range liquidity. Any liquidity that lies below where the market reversed from, this is external range liquidity. And this liquidity quite often is swept by the price. This liquidity quite often is swept by the price. As you can see, we had it being accumulated here, but now look at what happened the following day. So this particular week here is not a coincidence. It explains, or it fulfills the second law of technical market movement, because I explained in the previous video that technically market moves because of three reasons. The first reason, market moves to imbalance imbalances. The second reason, market moves to equalize demand and supply. And the third reason why technically any chart market will be moving will be to handle liquidity, if not to do the first two. Now, this particular candlestick is not a coincidence. When you look at that week, it was designed strategically, push it down to sweep these particular liquidities which were lying down over here, and then as you can see, it closed, and then of course the market continued to rally up. So now if you're trading an order block and it happens to be next to a liquidity pool, just be sure that the market will first sweep the liquidity before it can obey the order block. Now, quite often when you enter before the market has already swept the liquidity. So you become the liquidity and still market will go your direction. That's why when you engage so many traders, they will tell you it only takes me out and then goes my direction. It just blew my account, and from the exact point my account was depleted, it started going my direction, and it went for like 3 weeks buying consecutively. Immediately it just blew your account. Okay, so it's not that you are not lucky. It's only that you entered at a point of liquidity interest and you happen to be part of the liquidity. So that is the second reason why the market will move. So this is how I will recommend. If you are trading based on that particular approach, make sure that you wait first for any external range to be swept. You see, the problem is people have what we call fear of missing out. You don't want to be missed in any trade, and that now informs my next point, which is basically an entry becoming too early. That is the third technical reason why I think order blocks fail. Now, you see, most people are afraid to be left out by the price, and they forget that this price is constantly doing the same thing over and over again. So the price is not going anywhere. It's like being afraid of being left by a bus which is just going round, round the bus station or the bus stop. So you're sure another bus is coming, and then you are afraid of being left by the same bus. It is 10 times easier to get another setup than to get another trading account, and that's why you should be very technical. Actually, there are some battles you win by not participating. Not every entry is an entry. It is critical for you to make sure that you have only entered the high probability setups and don't have a fear of missing out. You will miss an entry. If you miss an entry and you stay in your office for 3-4 hours, I can assure you, you are likely to get another setup, probably in another pair or in another time frame. So you must not chase any entry. Now, if the market, for example, has not swept the liquidity yet, for example, let's assume technically, I draw this liquidity here. Let me show you something. This is my point of interest. This last candle that it printed, and then we had a rally upwards. Okay. Now I want you to see from where this candle happens. This movement was just to take out people who entered based on this. There is nothing else apart from liquidity being taken here. So my responsibility I would have waited for people to enter and then for the market to go down. And then once this candlestick closes with a wick, then this would be my entry point. In other words, where other people are getting out of the price, that is where you should prioritize to be your entry zone. Actually, and if you do this, you'll discover that you're increasing your win rate by even 25%. If you can make your exit, if you can make your stop loss your entry, I can assure you, you will do better than 90% of average retail traders. Now, why do people basically enter afraid early? I've explained because of two things. One, because of what we call fear of missing out, and two, because of something I call triple S, the short status syndrome, where you believe you're the short person in the price and then there is another person who is longer or who is taller in the price or who is more experienced, so you diminish yourself at an expense of other people. For example, you're just waiting for your entry well, but you go live on Instagram and you find one big trader from New York is already buying before the market has activated your order, and because you know this is someone who has been in the industry for the long time, and you know this is a big person who drives Rolls-Royce Cullinan. So you just enter based on theories that you have seen on Instagram, and you have not been able to wait patiently because you believe you're the short person in the market and you're the tall person in the... Now let me tell you, the truth is everybody in the market makes losses. The only difference between you and them is the losses that you make. If you lose 200, it's a big deal to them. Them at negative $500, they are still in break even. So I think that is the only thing that brings the difference. But alternatively, you should not forgo your analysis for anybody's analysis. Now, the third reason why the fourth reason why the market moves is because people do not trade based on specific kill zones. And these specific kill zones are the kill zones that manufacture or that are expected to have volume to push the price. Now, let me explain. We basically have major kill zones like the New York kill zone. We have the London kill zone, the New York kill zone, we have the Asian kill zone, it's also called the Tokyo kill zone. Now, each kill zone has a specific pair that are supposed to be traded. For example, it is very important for you to trade Japan-related pairs during what we call the Tokyo kill zone. Tokyo is in Japan, okay? That's like a basic thinking. So if Tokyo is in Japan, we are supposed to be trading during the Tokyo kill zone. Our interest should be JPY pairs. So USD JPY, CAD JPY, AUD JPY. Now, those are the assets we are interested in during that specific kill zone. Now, when we go to another kill zone, for example, there is another kill zone called the Sydney kill zone. Sydney is in Australia, so AUD here is in the game. So AUD USD, AUD CAD, AUD CHF, AUD NZD, in any pair that has AUD is your interest during specific kill zone. Now, when we go in the morning and then we have London session, of course, you know where London is. So Great Britain pound here is in play, GBP USD, GBP CAD, GBP USF. So when you discover the trading based on specific kill zone, you stop trading assets that are going to consolidate, because most of the time consolidation is formed where there is not enough volume to push the price either up or down. Now listen, whenever we have a consolidation phase, 90% of retail traders lose money in a market which is in a consolidation phase than a market which is on an actual trend. So you want only to trade during a specific kill zone to make sure that there is volume, because if you enter, even if the order block was a perfect order block, and then you enter and then the market consolidates within that order block, two things are supposed to happen. Number one, that particular consolidation will manufacture liquidity, and that liquidity might be swept. And once we sweep the liquidity, now we shall go to the direction. Quite often, good entries don't range. From my own personal introspection in the market, if you enter a trade and it starts ranging at your entry, there are chances that you might not make money from that trade. That is from my own introspection, from my own engagement. Remember, I've been in the market, this is my 6th year trading, and I've been here to know long enough that anytime you enter a trade, it starts to range at your entry, you might consider quitting the trade first. So this is because the liquidity might be swept to either side, either downside or upstairs, or downside or upside, and then the market will go to the direction that probably you had not anticipated. So it's very important for you to trade within a specific yield zone. Man, there is no certificate for suffering for 5 hours emotionally. Enter a trade which is moving within a specific time zone, unless you are swing trading. So personally, I'm purely intraday trader, and I want only to trade during the New York and the London overlap, because with that time momentum and volatility is crazy. I just want to enter the market after 30 minutes, 4 hours, 2 hours, I'm out of the market, because already market has already played out. And then lastly, the last reason why the market will fail to trade in your direction based on order block is because you are trading a wrong time frame order block. Man, let me just be straightforward. There is something we call the chaos theory. Chaos theory states that the formation, the algo engineering of every specific candle is the same across all the candlestick. There is no big difference between 1 minute candle and 4-hour candlestick. The only difference between 1 minute candlestick and 4-hour candlestick is the amplitude of those specific candlesticks. Now listen, the lower the time frame, the more chaotic the market becomes from the basic chaos theory, because every market is anchored on chaos. The unpredictability of the price is what we call chaos. Forex is nothing you can predict, because the charts are designed to do the exact of your prediction in any side. Even if you buy and sell, you will still find yourself getting cooked. So to a bigger extent, the amplitude of the price is very key. The amplitude of the candlestick is very key, because amplitude is the is the one that is going to give you some several pips. 1 minute candle and 1 hour candle, the difference is the chaos. The smaller the time frame, the noisier the market becomes. That is basic logic. Someone who is trading in 4-hour time frame has much more clarity than someone in the 1 minute candlestick, or in the 30 minutes candlestick, or even worst case scenario, 3 minutes candlestick, 5 minutes candlestick. So the smaller the time frame, the more noisier the charts become, and the more complicated everything else becomes. So it becomes very hard for you to navigate the markets correctly. Now, this is how you do it. There is something we call multi-time frame analysis, and this is very critical. Most order blocks are formed within other order blocks. There is a strategy I used to teach my students back in the days called order block in an order block. So if you're trading a 1-hour order block, try to look, do we have another order block within that order block from H4? And do we have another order block within that order block from 15 minutes time frame? I can assure you that is a higher probability order block than a 2 minutes, 3 minutes, 5 minute candlestick just placed somewhere casually on the air, and it's so visible and you can see it. By the way, this is how to avoid being a bait in any price, and I started becoming profitable, honestly speaking, when I understood this concept. Man, let me just be clear with you. You see, there is something called skepticism. It's a philosophy of doubt, okay? And it's very critical. Your ability to doubt extremely is what sets you aside from becoming baits of the market. Skepticism emphasizes on doubting, even whether you are doubting enough. You should even doubt and doubt your doubt. Bravo, you just found an order block casually placed somewhere where everybody can see this is an order block, and the market is coming very quickly to the order block, then ranging a little bit to the order block, indicating it might sweep up, and then you think now that particular order block gonna give you money, and everybody else can see this is an order block. I mean, it's common logic. So basic trades are the odd ones, and not so many people have eyes to see the odd order blocks. The odd order blocks are the ones that probably there is no liquidity below, of which not so many people will notice, because not even so many people know the difference between external and internal a range liquidity, a major and minor liquidity zone. So doubt every opportunity that looks easy, especially based on these particular order blocks. Any order blocks placed casually somewhere looks like a perfect reversal. My friend, doubt it big. Only enter high probability setup, the one you have analyzed and it has no red flag. Liquidity has been swept. You have done your multi-time frame analysis, the factor, and this entry is purely based on pure analysis and clean consent. It is not because you have been influenced by some tall guy driving a Lambo Bugatti. So this is Blue Ball Forex. I'll see you in the next one. This was a Forex conversation. It was not about strategies or anything. But if you want me to continue dropping kind of educative videos, please be sure to subscribe this and also share to your friends so that we can grow to 10,000 subscribers. And I'm gonna get motivated to do more and more content of this kind. In the next one, it's a goodbye from this side.